Hello, this is Paul Harris for Mining Journal. Today, I'm joined by Dan Wilton, CEO of First Mining Gold. Good afternoon, Dan.
Hi, Paul. How are you?
Very well, thank you. And yourself?
I'm doing very well. Thanks very much for taking the time.
Excellent. Well, let's start with a bit of background on First Mining Gold. The company began as a mineral bank, if I'm not mistaken, but it's in more recent times, you've transitioned into becoming a sort of gold developer. Now, that's quite a leap. So why don't you start off telling us a little bit about how that transition came about and what the aim is there?
Yeah, well, I think to understand the transition, you kind of need to understand the history. So the company, you're right, was put together as a mineral bank by Keith Neumeyer and a couple of like-minded individuals in 2015 or 2016 when, you know, the mining sector was on its knees, particularly for project development. It was very difficult environment to raise capital. And there were a lot of good projects that had been moved forward over the prior 4 or 5 years that people had just given up on. So Keith and a few like-minded folks formed a company and then just started buying projects. And they bought 8 companies or projects in 12 months. And that's what gave us this portfolio of projects that we have today. But I think as the industry evolved from 2016, 2017, 2018, one of the things that became very clear is that inside this portfolio of projects, there are real projects that are begging to be developed. And the mineral bank is the way mineral banks work best, in my humble opinion, is when you're buying gold at $1 or $2 an ounce in the ground, and ultimately you kind of trade at 10. But I think we were starting to feel like First Mining felt very capped at like a $10 an ounce kind of valuation, because by definition of being a mineral bank, people don't ever expect that you're going to advance, really work on, develop your assets. And particularly with Springpole, which is our biggest project that we're taking through pre-feasibility and in the environmental assessment process in Canada. This is a project that at $1,300 gold, our PEA set at a $842 million NPV. And we're trading at a fraction of that value. So, and there's reasons for it, perception reasons mostly about challenges of permitting. But, you know, understanding what we knew about Springpole, I joined the company at the beginning of 2019 and coming from a private equity background. So very much looking at risk return perspectives and, you know, where are you going to invest your capital to unlock the most value? And Springpole was a very, very clear choice for us, because this is a project that should trade. If it traded like comparables trade, it would trade at, you know, today, $90 or $100 an ounce, right? And we're trading, you know, if you just look at Springpole value, it's, you know, sub 20. So lots of room for value accretion to the upside as you take risk out of the project and as you demonstrate that you're going to be able to develop it. So I think we're on the path for people to appreciate that now, and starting to attract kind of a different group of investors who I think are here for the long term and here for the real development opportunity at Springpole.
It sounds like that's quite a sort of natural progression. You know, the bank, from my understanding of the bank concept, you're putting the resources away in the down cycle, waiting for better days. And when those better days come, you sort of take them out, dust them off, as you say, put the investment in to de-risk and to realize the value. So it seems to be quite a natural progression there. Now, you mentioned you're currently working on a pre-feasibility study for Springpole, which is in Ontario, Canada, and where you have a resource of 4.7 million ounces at just over 1 gram a ton. What's the timeline on the on the PFS, and what changes do you think will be compared to the PEA? How will it have progressed in advance?
Yeah, so the timelines, we've been at it since about November of last year. So we're rounding the corner and getting it finished. We had a goal of the end of this year. I think it might slip into January. But that's, you know, faced a few delays, not many delays, but a few delays due to the pandemic and some of the data collection that we were trying to get done in the spring. But we've got most of the work done now, the field work done that we need to advance the pre-feasibility. So this really is the time when you look at a bunch of those critical trade-offs. And I think where we've spent the most time, we're going to come up with a much more optimized mine plan than the deposit has seen before. I think we have a better understanding of the geology. We have a better understanding of how you go about to mine it and some of the grade sensitivity within the deposit. We've run trade-offs on really the size and scale, looked at, can you start small and expand? I think we're going to end up going with something that's not too dissimilar from the PEA in terms of overall size and construction size. But we've spent a lot of time looking at, obviously, the environmental impacts of the project and particularly at tailings. And have done some really interesting and robust trade-off studies on different forms of tailings management, conventional tailings, thickened tailings, dry stack tailings. And I think that's where we're likely going to see one of the biggest changes, particularly in the physical footprint, because, you know, I think we're looking at some kind of dry stack co-disposal. You really, really can shrink down the footprint. And importantly, for this project, which is getting built around a lot of water, it kind of forever puts to bed the question of what are you going to do when your tailings dam breaks and the tailings end up in the lake, right? I think if there's no tailings dam, there's no tailings dam to break. So we've been really focused on the environmental robustness of the project as we've taken it through PFS. Okay,
the PEA outlined a mine to produce about an average of 410,000 ounces a year for 12 years. Is that still the aim? Is there any sort of potential change there?
It's still, you know, we're still working on the final amounts of resource conversion and what's kind of converted to reserves. You know, PEA, you do have the benefit. Most of our resource at Springpole is indicated, so you'd expect that most of that would convert to reserve. We're still in the final stages of working that out. I think we may downsize the plant a little bit, but in the same ballpark. Is this going to be one of very few projects in the world capable of producing 300,000 ounces plus a year and up into that 400,000 ounce a year range? Absolutely. And I think that puts it in pretty rarefied air when you look around the industry, how many projects are capable of that kind of production in a tier 1 jurisdiction. This project is 100 kilometers away from Red Lake, Ontario.
Yeah, you mentioned a moment ago that you have a private equity background. Are you able to put a lot of input into how the PFS is shaping up in terms of the finance, you know, an eye on the financeability of the project? The PEA had initial capex of what, $109 million. You've currently got a market cap of just shy of $350 million. Mm-hmm. You mentioned the potentially a starter operation to then grow. How are you what kind of input are you putting into the process to really help it to be financeable?
Well, I think the first and foremost, what's going to help the financeability is having the most robust project we can. And that's been really the primary driver. Yeah, you know, we looked at that start small opportunity just to try and optimize a bit of a different element of the project. If you optimize your upfront capex, it often comes at the sacrifice of overall project robustness and NPV. There's duplication. You know, you end up delaying, particularly in Springpole's case, delaying getting to the best part of the ore body, because there is an area in the time frame that we're looking at mine it in kind of year 3, 4, 5, where you get into a bit of a higher grade part of the ore body. And I think good, sensible, thoughtful mine planning will try and bring that up front to minimize the payback period, you know, maximize the robustness and basically the quickness of payback. So we've looked at a lot of different trade-offs on that as we've moved through the project here.
Okay, you mentioned that Springpole, the deposit is under a lake, which isn't necessarily an unusual thing in Canada. A lot of mining projects, mines, have that situation. What are the sort of particular permitting and technical challenges that presents, and how do you plan to resolve them?
Yeah, and listen, I think it's a lot more perception than it is reality, and that's one of the things that's really come out of our out of the PFS process around some of that infrastructure, and particularly the cofferdams. We're talking about building cofferdams that in total are less than a kilometer long. There's about 800 meters of cofferdams. The average height of those cofferdams is 5 meters high. You know, the maximum depth of it is, I think, 14 meters. These just aren't really big structures in the context of when, you know, you look at the complexity that people deal with building dams everywhere around the world every day. So we've done geotechnical drilling under the footings of the cofferdam to understand its competent rock. We understand kind of the volume of lake sediments that you're going to be dealing with. And we actually had a very experienced group who have engineered, designed, and built the cofferdams at a number of other mines, including the Diavik mine in the Northwest Territories in Canada. And they've kind of come down and scoped, as part of the PFS, scoped the work program for how you construct those cofferdams. So from a technical perspective, this is not a technical challenge. This is not a difficult thing to build. Then it comes down to a permitting perspective. And one of the things that a lot of people don't appreciate about the project is that we've got 9 years of environmental baseline study around the aquatic environment and aquatic habitat and fish species and the terrestrial environment. Because as soon as they discovered the deposit that sits under this remote bay of the lake, that was naturally the biggest area of risk is what's the aquatic environment? Are you going to be able to get permits? This is now one of the best studied aquatic habitats in Canada. And I think when you go to the permitting authorities in a province like Ontario, where they've permitted 4 big open pit mines in the last 4 years, all of which are basically around a lot of water, and all of them dealing to varying degrees with disturbance of either, you know, rivers or lakes. There's a pretty well-established process to do this. And so, you know, we're in the same process and think that, you know, by virtue of the quality and the volume of the data we've been able to compile, you know, we're very confident we're going to be able to design, build, and ultimately operate this mine without long-term negative impact to the environment. But it leaves you then with a really important element of how you move the project forward, which is the partnership with your local communities and securing your social license. And on that front, you know, the project's been in the environmental assessment process provincially and federally since 2018. We've been in active consultation with our communities for you know, for 2.5 years now, and I think making very good progress.
Okay, and is that the main challenge, the biggest challenge you face, or what other challenges do you face to bringing Springpole into production?
Yeah, you know, certainly the I mean, let's divide this into the challenges we face in getting Springpole to the point where you can make a construction decision. And then the challenges you face in taking that project, you know, into reality and, you know, putting it into production. So our primary task in the next 2.5, 3 years, submit our environmental impact statement, complete a feasibility study, continue an active dialogue and consultation with our Indigenous communities, and ultimately secure our federal and provincial environmental assessment approvals. And when we have those, we're in a very different position to then think about the risks of construction financing and building the mine. But that's a 2023, 2024 decision. And I would have told you at the beginning of last year, the biggest challenge we would have had would have been access to capital and making sure that we're well enough funded to get there. And today I would say we've pretty conclusively answered that question through a few of the deals that we've done, the Silver Stream to provide the longer term funding for Springpole. We raised just shy of 30 million Canadian in equity in August, and we've sold our Gold Lund project to Treasury Metals to combine with the Goliath project. We've optioned our Pickle Crow project. And so we're now sitting with about a 350 million market cap, but about 250 of the 350 million is tangible value for other projects in the portfolio and the cash that's on our balance sheet. So, you know, I think we've really kind of put that how are you going to raise the money to keep yourself alive question behind us, which is a fundamental change in the risk of this company.
Okay, so just to follow up on one of those points there, the company started out as a mineral bank, and yet you now seem to be in sort of asset divestment phase to really sort of focus on Springpole. You mentioned that in August you did the deal with Treasury Metals, which combined Goldland and Goliath. What was the sort of the rationale behind that deal? Was it just to sort of remove assets so that you can have that exclusive focus on Springpole?
No, I mean, the real rationale for combining Goldland Goliath was that the two projects are basically contiguous. And together they can ultimately be a far more robust project than each of them separately. So the concept isn't that hard. You're going to build one mill, you're going to feed it from two mines. And Goldland has a ton of exploration potential, as does Goliath. But for us, developing that on a standalone basis, to then go seek your permits to build another mill 25 kilometers away from where someone else already has their federal environmental approvals for a mine, mill, and a tailings dam, ultimately didn't really make that much sense. We kind of saw the same vision as the Treasury team about how you can consolidate all of this and ultimately really de-risk that combined operation. And so, you know, we believe in that upside, continue to believe in that upside. And the Treasury team's doing great work in ultimately moving toward a PEA, which they should have out early next year, on what a combined conceptual operation would look like at Goldland and Goliath. But I think it's going to be one of the most robust development projects in Canada, and in one of the easiest places to build a mine. I mean, the Goliath mine and mill is just off the Trans-Canada Highway, 15 minutes outside the town of Dryden, Ontario, with every bit of infrastructure you could ever imagine to build a mine, and a place where everyone can drive home at night. So no, we think it's a really exciting opportunity putting those together. So it meant that it could become self-funding, because Goldland for us, if we were continuing to spend $4 or $5 million a year on exploration, when we were sitting at 100 million market cap, us doing that was actually incurring pretty meaningful dilution in our ownership at Springpole, which we believe is worth multiples of our current market cap. So it was really kind of putting them together, more robust development plan, and, you know, ultimately giving our shareholders an opportunity to become direct shareholders of Treasury, which we're excited about as well.
So was that a straight sell, or do you still have sort of upside participation there?
Yeah, it was a sale for shares and warrants, which we received at closing. So we own about 40% of Treasury. And we have a bunch of warrants that are sitting at or around at the money right now. We also took a royalty on Goldland and have some deferred payments on them hitting milestones around getting mining lease, permits to mine at Goldland, and then ultimately kind of first production of ore. So it's various stages of different types of compensation. But no, if it's successful, we're still far and away the largest shareholder of Treasury, and will continue to be for the time being here.
Excellent. Well, it sounds like you've had a very productive year or so, and it sounds like you've got some very good milestones to come next year. Unfortunately, that's all we have time for at the moment, Dan. Join us for more on mining-journal.com. Thanks very much, Dan.
Well, thank you very much. Appreciate you taking the time.